You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp. I love that rockin' theme. It really gets me in the mood to do some basic training and some instructing of the old drills. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding Options Insider Radio Network. And if you haven't had a chance to check it out, to download it yet, listeners, don't walk over to the App Store of your choice and find our Options Insider Radio Network mobile app. You can find it in, of course, the iOS App Store, the Google Play App Store, even the Amazon Kindle Fire App Store. We've made app versions for all of the leading platforms, so pick your flavor of choice, head on over to the App Store, download the Options Insider Radio Network mobile app. You can, of course, instantly stream all your favorite episodes from Options Bootcamp, as well as all the other programs on our network. You can download them, save them for some offline listening. If you're going to be on a plane or a subway or what have you, you can listen to all those episodes there. And of course, you can use the app to stay in touch with us here on the shows. Send in your questions, your comments, your feedback. Just hit that contact tab, and you could send us all of your favorite comments. And we love to hear them here on the show, so send them on in. Once again, it's the Options Insider Radio Network mobile app. Check it out in your app store of choice. All right, and joining me on the old Options Bootcamp drill instructor squad this week, my usual cohort of companions, my partners in crime, starting off with he of the black hat, a.k.a. the prima donna himself, none other than Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show, sir.
It is splendid to be back. I'm ready for some boot camping myself.
I think we're all overdue for a little bit of boot camping. And speaking of being back, he is back and raring to go. None other than Mr. John Critchley, the options major domo over there at sogotrade.com. John, welcome back to the show and welcome back to the land of the living, sir.
Excellent to be back. I'm feeling great, and I'm ready to go.
All right, without further ado then, let's get started and dive right on into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, welcome to the basic training segment. I always get that patriotic feeling whenever I hear that music. It makes me feel like it's the 4th of July instead of deep, deep in the bowels of winter when we're recording this, listeners. Of course, I know a lot of you are coming to this episode further down the pike, so it could be summer, could be fall, could be whatever time of year when you're actually listening to this episode. But for us, it is deep in the polar vortex heart of Chicago as we're recording this, and of course, out of New York as well. Well, welcome to the basic training segment. This is, of course, the portion of the program where we take some basic options concepts and we break them down for you, the basic retail options trader, and we tell you how you can incorporate these trades into your own trading, into your own portfolio, so you can use them in a variety of different capacities. And that's what we're here to show you today on the old basic training segment. And what we're going to talk about today, we bandied it about a little bit before the show of what should we really talk about, what should we hit on. And, we talked a lot about adjustments on our last few episodes. So we thought we would take the conversation and start it with a kind of a corollary to adjustments, and then we'll roll into something that is even more topical for what's going on in the market right now. So I'll kick things off, as you remember, last few episodes talking about adjustments, rolling, closing out positions, things like that. Well, when you're adjusting or when you're even just setting up regular type trades, particularly spreads, there is a technique that can be useful when you're doing these, and that is called legging. So what do we mean by legging? Well, it's really a very simple term. It kind of harkens back to the old days of the floor. That's what we used to call it back then. I'm going to leg into this and leg into that. And what it means is let's take your simple two-legged spread, could be a vertical, whatever the case may be. And instead, usually when you put on a spread, you're going to go to your brokerage platform. You're going to select that spread of choice from the drop-down menu there. Let's say it's a vertical. And then you're going to enter your price. You're going to hit execute. And the whole trade's going to be put together as a package and executed as a package. But as you know, when a spread can have multiple legs, those are the individual components of a particular trade. Let's say you're buying an at-the-money call and then selling an out-of-the-money call against it. You're making a vertical call spread. Those individual legs are the components of the trade. So let's say instead of executing it as an entire package, you could execute the individual legs separately. And that's what we mean when we're talking about legging. And it's an interesting proposition. It's what a lot of professionals usually do when they're getting into spreads because they feel, given their expertise in the marketplace and given how they like to execute their trades, they feel they can usually get some sort of advantageous price for when they're legging a spread. So Dan, I'm sure you have this conversation a lot over there with your mentees, with your clients, over there at Market Taker Mentoring. First off, give me your take on legging, your 2 cents on it, and then why don't you walk us through a basic example? Let's say legging into like a vertical call spread, or whatever flavor strikes your fancy, sir. I'll leave it up to you. Dealer's choice.
Legging is an awesome tool that any trader who's been trading for a couple years ought to have in his little bag of tricks. The thing with legging is that it can be a really, really great thing, but it can be a bad thing if used incorrectly. Traders really need to be careful with making sure that their legging is part of a plan, not a knee-jerk reaction, and that they have reasonable expectations when it comes to legging. Like you can't rely on the market to do something. You can't require the market to do something in order for your leg to work out right. Otherwise, you can really run into a lot of trouble.
All right, and Mr. Critchley, you obviously get a lot of calls about legging and spreads over there at Sogo. Why don't you give us your 2 cents on legging, and then maybe later on we'll walk through a few scenarios when maybe you should leg a spread and when you shouldn't.
Sure. I mean, the bottom line is this, and I love to leg, and Mark is right. Traders on the floor do that all the time.
John, is it fair to call you a leg man then?
Yes, it is. The bottom line is, if you have profitable trades in your portfolio, you should always consider, I'm not saying you should always consider legging into a spread, okay? That way you have the ability you will limit some profit potential, but you're also you can lock in some profit. So I always tell customers, and they call me up and say, I had this trade on, it's gone in my favor, what should I do? And I always advise, maybe you should leg into a spread. So that's the most basic thing. Now, if we're talking about a customer who has no positions on and wants to enter a spread, that's a whole new ballgame. Maybe Dan and Mark can talk about that. That's, I think, what Dan was speaking about, much trickier And I normally advise retail customers not to try to leg into spreads. If you have no positions on and you want to do a spread, we don't normally recommend that you try to leg into it. It's very tricky. It can quickly go against you. So leave that more to the pros or the more professional traders, legging into a spread just to start off. That's my opinion and what I usually counsel our customers.
I'm right there with you, John. I counsel my students on that as well, because here's what can go wrong. Here's like one of the biggest mistakes I see people make when it comes to legging is, they say, well, I want to put on this bull call spread, for example. And they say, well, what I'm going to do is I'm going to buy the one call now, and then later after the stock goes up, then I'm going to sell the other call. So I end up putting the spread on at an advantageous price. Brilliant plan, except what happens if the stock doesn't rise? Then you're stuck with this call that you probably don't even like that position anyway to begin with, and the call's going against you to boot. So I have a couple rules. One, when it comes to legging, always love the first leg first, because you may never get that second leg. And I think John's rule for most people is perfect, and that is just don't leg into a spread like that where you need something in the future to happen in order for it to work out for you.
Yeah, those are all really good parameters for legging. And that's, like John said, this is really why we want to touch on this now, right on the heels of our episodes about adjustments, because the first use case, and probably the best use case for a lot of retail options traders to start legging spreads, is when you have a single leg trade going in your favor, like we talked about on the adjustments episodes. Let's say you have that proverbial at-the-money call in XYZ, the underlying rallies, 10 handles in your favor. Now you have an at-the-money call that's now a $10 in-the-money call. Well, what do you do? Remember we talked about it last episode. You could sell it out. You can do a lot of things. One of the things you could do, though, is to leg into a vertical spread and sell that now, the new at-the-money strike, at who knows, at a level that could even be higher than what you paid for that initial at-the-money call back in the day. So you're actually legging into a vertical spread for a credit. A very, very advantageous scenario. It doesn't happen that often, but that's one of the real, probably the best use case. I probably agree with John and Dan there for beginning retail options traders. If you're looking at a trade from the beginning and saying I want to leg into this spread, that's a more complicated scenario. There are a few reasons you may want to consider that as well. For example, let's say you're a pretty experienced guy. You've been around the block a few times. You're looking at this vertical call spread in XYZ again. Maybe you want to buy XYZ's at 50. You want to buy the 50-60 call spread. And let's say the 50 calls are trading for $5 and the 60 calls are trading for $1. So, you can buy that spread as a package for $4 right now. But you think, what? I'm a pretty good trader. I can actually leg into a cheaper price by working a bid for that at-the-money call, and then once I get filled there, trying to work an offer for the at-the-money call, and you think if you're really good, you can leg in for maybe $3, something like that. So you can save $1, you think, if you have a good understanding of the underlying and you're a pretty sophisticated options trader. But again, that's a pretty limited subset of the audience, so you should really only consider that if you're particularly savvy. Another reason to maybe want to consider legging spreads is something we talked about a lot on this show and other shows on the network, is that spreads in general are still a problem in the retail option space, spread execution in particular. So if you go into your broker of choice, could be Sogo, and say, hey, I want to execute this trade, well, guess what happens? It gets packaged as this spread, and it gets routed off to a particular spread book on a particular exchange. And there's a lot of technology and things that go into that routing decision, and that's pretty much where your spread lives. And different brokers do different things to get that spread executed, and maybe John could talk about that a little bit. But essentially, you're on that spread book, and now it could be trading on other legs, it could be, the MBBO could be where your spread is, and yet you're not getting executed because you're sitting on a spread book on a particular exchange where they're not actually on the MBBO on one leg. They could be bid a little lower on the calls, offer a little higher on the other money calls, whatever the case may be. And so you're sitting there, even though the MBBO says you should be done, and you're not done. So that's a scenario where you could potentially consider legging it if you want to go in, lift the liquidity on one exchange, hit the liquidity on another exchange with individual legs. Then you can trade on the MBBO and maybe get filled in a scenario where you wouldn't otherwise get filled. Again, that's a strategy, that's a use case for a bit more sophisticated audience than I think the audience for this show. But I wanted to really lay it out there. That is a viable scenario for legging in the modern environment. It's one that's sprung up as a result of all the complexities and nuances of executing spreads in the current market environment. Of course, with those upsides, there are potential downsides. Like, for example, all the risks Dan and John just outlined. If you put on a leg of any spread, you now have that directional risk. You have all those Greek risks while you're waiting for the other leg to come into line. And what if it doesn't come in line? That's a problem. You now have a single leg that is going against you pretty dramatically, and that could not be exactly what you want. And that's why you use spreads to begin with, to mitigate some of that premium and capital risk so the trade isn't as risky. And if you're doing a short premium trade, again, you're using the spread to mitigate some of that risk, to spread it off so the trade by itself isn't that risky. But if you're just doing one leg at the beginning, you now have a single leg trade with all the inherent risks associated with that. The other, of course, downside is commissions. You're going to pay full ticket charges for each leg of that spread, whereas if you quote it as a spread, the broker's going to give you some sort of discounted spread rate. So you're paying a little more to do that trade. And just in general, I do want to leave you with this. Dan mentioned loving the leg of your spread. There's a good rule of thumb we had on the floor. I think it actually applies to life in general, too. When you're doing a spread, always do the hard leg first, and you're going to know what I mean when you see your spread. Most spreads, like let's say at your vertical again, the hard leg is going to be the meatier option. It's going to be the at the money or in the money option that you're buying versus the out of the money garbage option that you're selling. That if you're going to leg it, do the hard leg first. And if you know enough about spreads, you know which leg of your spread is the hard leg. Get that done. You can always worry about getting the little worthless out of the money call out later at a different price. It's not going to go against you that badly. But the deep leg, the meaty leg, if you will, is the one you want to really focus on. So there you go, a little basic overview of legging. Before we roll on, John, I'll give you both of you guys a chance to kind of give me your final thoughts on legging. Perhaps, John, the leg man, we shall start with you.
Well, I want to mention from a margin and risk standpoint, if you have the choice, it's always prudent to do the buy side first, because if you do the short side first, it's going to create margin problems, and you may not even be able to put the short side on to begin with. So if everything else is equal, try to do the buy side first. Mark's 100% correct. Always do the hard side first. If you're doing calendar spreads, that would always certainly mean trading the back month, first. That's the hardest month, probably the less liquid month. So do the hard month first. And if you're going to do some kind of ratio spread, normally I would advise to do the higher quantity first. So get the higher quantity first. So then the spread runs away from you. Well, the small quantity is running away from you, not the larger quantity. So those are some little advice if you're going to do legging. And one more quick thing, Mark was 100% right. The one time the spreads are good to do if you want to initiate a spread is if you go to do a spread and the NBBO is really tight, but guess what? The calls are bid on the SIBO and the other calls are offered on the ICE. And if you want to do a spread, they won't fill you on the Philly spread book. So that way, that's an example where you can do it. You can leg into it very quickly. Do a trade, do another trade. And remember also, if you do a spread, you're paying a SOGO trade, and most other firms, some not, but most other firms, only one ticket charge. So doing spreads as a package is going to cost you less than legging in. So legging in is for the pros. If you need to do it, it's okay, but just be careful when you put it on.
I'll kind of add a little bit to that as well. I kind of look at there being sort of three different types of legging. There's legging in, and there's legging out, and then there's legging and adjustment. And I'm with John and Mark. Legging in, careful with that. Legging out can be really great. We've talked about legging out of straddles, I think, in past shows, like sort of a quasi retail based gamma scale legging out of a straddle, and reducing the size of a position. But legging and adjustment can be really, really great, really, really powerful. And I love doing that kind of stuff. Like when a time spread goes against you, leg into a double calendar. when you have on like a put credit spread and the stock rises up to like a resistance level, then put on a call credit spread to leg into an iron condor. Um, there's a lot of different techniques and such, but really what it all comes down to is, be creative. Don't be afraid to sort of try something new, but just make sure that it is part of a plan and you're executing a plan that you had in mind since the beginning and not just, being willy-nilly about it.
You don't trade willy-nilly. That's my strategy from the get-go, sir.
Well, if that's part of your plan from the beginning, I guess it's okay.
Are you slamming my plan, sir? That's it. I'm coming to Frankfurt. We're going to have that in-person conversation. All right. Now, moving on from legging, we wanted to touch on that just a little bit because it does, like I said, tie into what we were just saying about adjustments. But we also, it's not really a full topic for a show. We also wanted to hit on something that is very salient, we know, to a lot of you listening right now, and it could be indeed down the road as well. This is always a topic that comes up with a lot of you out there, basic retail customers, even more advanced guys. A lot of financial advisors want to know this information as well. And you can kind of summarize it in one term there. It's protecting your gains. Now, we talked about playing defense in the past here on the show. You can go, of course, check out our archives and look up all of those episodes we've done there where we walk up through some strategies. We're going to hit those again with a little bit more of a focus on what's kind of going on right now in the market in a scenario that might impact a lot of you. For example, we're recording this right now early in March here in 2014. You could be listening, of course, at any time, but that's the magic of their Options Insider Radio Network. But in this time frame, of course, we have had an extended bull market in most of the major indices. And most people are sitting on, if they have just a broad market portfolio, are sitting on substantial gains, probably 10% or more at the very least. A lot of individual names out there have also rallied, Apple, Facebook, what have you. So they could be sitting on a lot of substantial gains in a particular individual name as well. And what we've also seen over the first few months of this year is protracted and prolonged periods of volatility in the market where we're selling off 1% in the S&P on a given day and then rallying 1.5% the next day. And that's unsettling to a lot of people, particularly people who come to the options market for a first time from the equity world where they're primarily trained on buy and hold. And to see all this intermediate fluctuation is a difficult thing for them. And a lot of people have these gains and they want to protect them. They don't want to lose them. And of course, we've seen very recently some macro shocks to the system. Like, of course, we're talking right now. We saw a few weeks ago Argentina. More recently, we saw what's going on in Crimea with the Russian troops getting boots on the ground over there, shocking the system over the weekend. And these shocks could retrace the market several percent easily, and there goes a lion's share of your gains in one fell swoop. So these are scenarios where even if you're a buy and hold person, you want to think about how you can protect these gains against these sorts of near-term fluctuations. You don't want to gain 10, 15% and give away half of it in some ridiculous macro shock and then have to regain there from that point on. That's just not a scenario anyone wants. So it's important to hit on this stuff right now, given what's going on in the market. And of course, you guys out there really like to hear about this stuff too. So maybe let's start off with, of course, the most basic protective thing. Let's say you're up 10% in SPY or whatever the case may be. If you're just done, you have your gains and you don't want to worry about it anymore. Of course, the most basic thing, getting back to our adjustment shows as well, is close it out. But we're not here to talk about closing it out because anyone can do that. There's not much skill once you do that. But we're going to get a little bit beyond that, of course. The number one easiest way for a lot of people to really lock in those gains they have is to purchase some sort of either at the money or near out of the money protective put. Again, we have an entire episode on that where we walk through all those examples in a lot of detail. But what's useful about this is that it's a great way to stay long the market, which a lot of you want to be. You're still bullish overall on the market, but you don't want these near-term shocks to really cause you to have sleepless nights and to have all the attendant issues that go along with that. So a protective put, a great way to lock in whatever level you want to lock in. If you want to lock in at the money, that's fine. If you want to lock in a little bit below the at the money strike, maybe 3-5% out of the money, whatever level you want to lock in those gains. If you of course have made 10% in the market, maybe you want to go closer to the at the money to protect those gains against some near-term retracement. Of course, remember, listeners, the closer you go to the at the money, the deeper that meatier that put is, the more you're going to pay for that protection. So this becomes the perennial song and dance that you have to do whenever you're looking for any sort of insurance type product, is how much do you want to pay versus the amount of protection you want to get. And in general, people always write in, what's a good rule of thumb for X or how much I should pay for a put. And there really isn't one, but what we've seen in general, doing a lot of anecdotal research on this and talking to people and looking at our own execution, and maybe John and Dan, you guys can weigh in with your own ideas on this, is it generally falls somewhere in the realm, if you want decent, maybe a little bit out of the money protection over 3 to 6 month period, you should be comfortable spending anywhere between 1 to maybe 2% of your capital there to allocate towards that type of protection. And if you're willing and comfortable to do that, then you could spend that money to lock in and protect against any future gains. Of course, if you go farther out in time or you go deeper in the money, then that cost is going to rise. But in general, a near out of the money put, let's say somewhere in the 3 to 6 month range out there, depending on where you choose your strike, should be in somewhere in the 1 to 2% range. As long as you're comfortable with that amount and you're sitting on 10% gains, maybe you are, then you could consider locking that in. If you're not comfortable with that, then you should probably consider closing out your position, because that's probably the base cost you're going to have. All right, now, of course, you can do other things if you're worried about cost as well, including, let's say, legging into a put spread. So, Dan, why don't you walk us through, your basic protective scenario. I'm assuming it's a protective put, but maybe you have something else. And then B, what you like to do to offset some of those premium costs, maybe, let's say, legging into a protective put spread.
Sure. Legging into a protective put spread, here's how that works. So imagine you have a stock, you're concerned that it's going to go down, and you want to buy a put. Because of the relative expense of puts, I mean, you can pay 4 or 5% of the value of a stock buying a put sometimes. So that can be a pretty tricky proposition. That's where the protective put spread comes in, which is a put spread that eliminates a lot of the cost of owning that put, but it only protects you so much. If the market crashes, the stock loses 90% of its value, you don't get all of the protection. So legging into it can be pretty practical. Usually when you have that urge to buy a put, it's because you're expecting something pretty imminently to happen. And in that regard, I think it's okay paying up for a put. I mean, hey, man, you get what you pay for sometimes. But if the stock begins to fall, and then, like, as the story unveils, it looks like it's not going to fall quite as much as you originally feared, that's when I think it can make total sense to go ahead and sell one of those lower strike puts, capping off the protective value of the put, but taking in a whole lot of premium to really, really offset the cost of that put. So, you guys kind of understand what I'm saying. So it's kind of I buy the put right now, even though I'm paying up. I need that protection, but then the stock falls, and okay, it looks like it's not going to be a crash scenario, but I kind of like having the put in place. Boom. Now I sell that lower strike put, take in some premium, and that can be a really, really great way to do it.
The one thing that I wanted to mention was, this is slightly off topic, but I like to call this time of the year, or have us about a few times a year, called crisis trading. Crises like Mark was saying occur. And I'm a premium buyer by standard, but this is when I like to sell premium. I think everyone just starts hyperventilating, and this is the time where I like to sell put spreads. And now, hindsight's great, but this Russian event that happened over the weekend and the Monday as we record now, it's Tuesday. It was just that was the textbook example of this complete overreaction, and the implied volatility skyrocketed in the Russian ETF index, and it was just a prime opportunity to sell. So if I do something like that, I don't necessarily want to sell premium, but I maybe want to sell some put spreads. Getting back to the topic at hand, my favorite trade, and we've mentioned this in the past, and Mark mentioned the podcast that we did. That was an excellent podcast on this topic. Is the costless collar or zero cost collar. That's when you buy the protective put. But again, people are always saying, oh my God, I have to buy a put, it's going to cost me money. But if you're writing out a money covered call with this, and you do it for a negligible cost or maybe even a credit, then you don't have to worry about the premium. And it protects you against a black swan event or something like that. And again, we've mentioned this in the past. They've done studies where shown that if you've done this type of strategy in times of high stress, that you have outperformed the market as a whole. So that's my favorite trade, the costless collar.
Yeah, that's a great one to bring up again for this exact type of scenario. You are concerned about some near-term shocks to the system like Russia, like Argentina. Who knows what your trading is and what the potential shocks are. It could be negative earnings outcome, whatever the case may be. But you're still long, you're still bullish. You want to own that underlying. And so this is the constant dance. I like to make sure our listeners understand. There's this constant dance of, well, maybe I should, if I'm questioning the near term of this underlying, I should just sell it. And that's a very prevalent mindset. It's kind of somewhat disturbing, but c'est la vie. That's a lot of people have come to this from the buy and hold, or if you're thinking about buying a put, you should sell it. But there are, like we said, many times where you're still bullish the main underlying that you're holding, and there's all these other external factors that could be at work that could really give you a big downturn in the near term, like Russia, like other things, macro factors that don't really change your underlying that much, and yet could still impact it from just a pure beta perspective. And you don't want to have to pay that cost. So this is a good example of when this type of protective strategy to protect your gains, forget about just protecting your underlying, protecting the gains you've made in the marketplace is really important. And that collar is a good example. John walked through the costless collar example. That is, of course, where you buy out of the money put, let's say an XYZ, let's say XYZ is trading 50. You buy, let's say, the $5 out of the money put for $1, the 45 strike put. Then you turn around, let's say you sell the 55, or maybe more realistically, the 53 strike call, also trading for $1. And now you have set up a collar that is cost you nothing, and you get some protection. Of course, the downside, literally, like I've said to many costless collars, is that they're not ideal. And particularly if you're looking to protect all of your gains, you want to get a little meatier with the put. You want to get closer to the at-the-money strike, if not the at-the-money itself. That's going to be more expensive. It's going to be difficult for you to write a call to really offset all of that cost of that premium, unless you turn around and write the at-the-money call. And then, of course, you've done nothing but really done a synthetic selling of the stock. And so you don't want to do that. So that's going to be difficult. So if you look at it from that road of trying to set up a costless collar, it may not be ideal for protecting a lot of your gains, just because you're going to have to probably migrate a little bit farther down the option chain from a put perspective than you maybe are comfortable with. If you want to lock in those 10% of gains that you just made and you want to protect them, you want to be close to the at-the-money strike. So if you're comfortable paying a little bit for a protection, then the collar is still ideal. Another way you could think about using the collar to your advantage and helping to protect some near-term gains is, I guess, what you can call a collar plus, collar with a kicker. Call it what you will. But what this is essentially the same collar we talked about before. You're buying a long out of the money put usually, or maybe near at the money put, depending on where you want to go. Writing that out of the money call, and that's going to offset probably, remember we talked about implied volatility skew here on this show. The puts have more implied volatility premium than the call, so it's very rare you're going to find an equidistant call that's going to offset all of the price of that put. So probably you're going to sell an out of the money call. It's $5 out of the money, let's say, and that's going to offset, let's say, a couple of dollars of that put. You may still have a little bit of premium left over. If you want to reduce that even further, you add this extra leg, extra kicker, which is what makes it the collar plus. And then you also write a put spread. So you buy a put spread to the downside, and then you write that covered call to the upside. Now, why would you do that? Well, of course, it reduces a lot of your premium outlay off the bat. B, you're really, in this scenario, mostly concerned about a very near-term correction in the underlying that's going to wipe out your gains. So as long as you key your protection around those gains, you should be all right. If you're buying that put and writing it at the level, the out of the money put spread leg at the level where about you break even, then you're protected pretty much all the way down to that break even point where you first bought the underlying. If you're concerned, of course, about a larger scale move, then you may have to reconsider what your underlying expectations are, what your scenarios are, and where you want to write that put if you want to do it at all. Again, that kind of collar plus is really for a scenario where you're only worried about a near-term retracement in the underlying, and you want to protect those gains. It's not for the catastrophic scenario, obviously. If you're worried about that, A, maybe sell the position, or B, get some meteor type protection that will protect you farther down the chain. So, Dan, do you do that collar plus, I guess you can call it, a lot over there? I know you talked about covered strangles in the past. This is kind of a similar type of strategy. Instead of covered, I guess you can call it I think collar plus is a good way to go about guy. Do you ever use that strategy? You ever discuss it with your mentees, A? And then B, if you do, or even if you don't, what are some of your other preferred strategies for really locking in a gain without having all of the inherent premium of just buying that, let's say, at the money put?
Yeah, Doing trades like that are stuff that I often talk about more in like my one-on-one coaching and when I do consulting. Like for example, I had a guy who, oh, I probably mentioned on the show once or twice before, who had a really really concentrated position in Apple. This this was when Apple was, sky high. What was it, 800 or something like that? Like we were talking at its peak. He was smart enough to know, hey, I got a really good thing going here. I need to protect this. And he owned Apple for a long time. He had, well, I don't know, million or two or three or something like that worth of just Apple stock. It was most of his portfolio. And we would talk about things like buy a longer term put and then sell shorter term closer to the money calls against that put. And you got to kind of actively manage it. That's sort of different than a typical collar because you have the different expiration cycles and you kind of have to go a little closer to the money with those shorter term calls. So you really have to actively manage. And the guy sure didn't want his stock to get called away because he owned it at a pretty low cost basis, so he'd get taxed up the wazoo. So yeah, I mean, really the bottom line is, I mean, we can talk about a whole bunch of techniques, and I imagine we're going to talk about a few more very specific strategies. But just kind of like I said before, don't be afraid to be creative. You guys have been listening to the show for a while. You have a good feel for how options work probably by now. Don't be afraid to try some strategy that kind of seems to make sense. And maybe you don't really know what the name is or what it's called or anything, but it's okay to kind of try and cobble together your own strategy to fit a specific situation.
The one thing I want to mention, and I'm actually reluctant to mention it because I am in principle against these type of products. But if your customer, if one of our customers is concerned very short term, something may happen over the weekend, there's an event coming up, whatever the case, and it's a 1 or 2 or 3 day maximum event, they believe they can try to use a leverage or inverse ETFs. Now, again, we know that the way these ETFs are set up, and they're embedded with a path dependent component. So what happens is that over long term, there's a huge value destruction for the buy and hold investor. So they're very unsuitable for most customers unless you're very, very short term. So that's one little thing. If you're very short term and you want to get in and out and you want to sleep for a few days well, and that's it, you can try, one of the leverage or inverse ETFs, but definitely do not make that a core part of your protection plan. This is only for a short-term event, and that's the only way I would ever use those.
Wow, a plug for the inverse ETFs here on the old Options Bootcamp. I never thought I would hear that come from you, sir.
I think lightning may strike me down as I walk home today. I don't know.
But you're right. That is, I guess, better than nothing, certainly, if people are going to sit there and just hold their underlyings. I've often only slightly jokingly referred to those levered inverse ETFs as essentially the poor man's option. That's exactly what they are. They are very poor substitutes for options. They don't perform as well. They don't do a lot of things as well as constructing these positions yourself. But I suppose in lieu of just sitting there long and then just letting it go back to your break-even point and losing all those profits, I could live with a levered ETF, let's say, over just letting all those profits go back to zero. So there you go. But of course, this is an option show. We're going to advocate on the side of options because we've been doing this for a long time and we know they perform a lot better. So there you go, listeners. That's just kind of a basic overview. Again, if you want more details about each of these strategies in general, we've talked about the collar individually on a whole episode of this show. Just check out our archives on the optionsinsider.com or there in iTunes or Stitcher, wherever you listen to this show. Also check out our episodes on protective puts. I think we called it playing defense. There's a lot of great archive episodes where we get into this stuff in a lot more detail. We kind of wanted to just use this scenario. A lot of you guys writing in, a lot of you guys right now just generally concerned about a kind of top-heavy scenario in the market and how to protect some gains. And these are just some quick ways to do it. Collar is fantastic, zero cost or otherwise. Remember the limitations of that zero cost collar if you are going to do that. At the end of the day, you should be willing to pay for a little bit of protection if you really want to protect your position. Insurance isn't free no matter where you get it. And as long as you can wrap yourself and your mindset around that, I have to actually pay a little bit for this to get really good quality protection, I think you'll do all right. If you're fixated on the zero cost, you may end up writing too many legs against a long leg to offset it, A, or B, just setting up some sort of zero cost type scenario that doesn't really give you what you want. You do get what you pay for, even in options. So if you want some very, very close to the at-the-money strike protection, you're probably going to have to pay for that. And that rule of thumb I put out there is generally, I think, pretty good. Before we wrap up on that, Dan and John, I'll let you weigh in too. Do you guys, in general, agree with that rule of thumb? Somewhere between 1% and 2% you should be willing to outlay in order to protect yourself for somewhere in the 6-month time frame or so?
In the 6-month time frame,
let's say 3 to 6 months. 3 to 6 months.
Yeah, I mean, if you can get a put for that, if you can get protection for that price, yeah. But I mean, I do still think you need to be somewhat selective. I mean, I don't know. I mean, I guess 2%, top end for 3 months. That's what, 8% a year you're giving up. So I think you still need to be a little bit selective. I wouldn't, as a rule, always have protection on at that price point. But yeah, I think it's reasonable when you feel you need it.
Yeah, that's if you're doing it for 3 months, you got to really be worried about some near term in the downside, and you're willing to also think there's some bullish ahead, and so you're willing to pay that amount, because otherwise you should be doing other things like maybe closing out the position. John, what's your take on that?
Yeah, I'm a big advocate of protection. I mean, and if anyone's not a big advocate of protection, then all they need to do is go back and look at 1999, 2000, and all the people, or even some famous people that, lost, 80, 90% of their holdings. So I actually would skew more towards, that 2% over a 3 or 4 month period. If I have to give up, 6 or 8% over the year, I'm going to live with that just to protect myself, because, this bull run that we're having now, it's just, to me, really incomprehensible. But, at some point it's going to end, and who knows what the trigger will be, but it can just happen at any time. And I think that our customers out there should be, have some protection, just so all these wonderful gains that they've had don't evaporate over, a month or two. Look what happened in 2008. And there's so many examples that, just be careful, folks.
Yep, all good strategies, all good advice. Remember, we're not just advocating for options here for the sake of options. This is really what we believe. This is really what we think is beneficial to you. If you're coming to the markets and you're just long only and you're just riding the wave up and down, you're really not doing yourself any favors. And a lot of the strategies that we've outlined here on this show in the past couple of years can really help you cut out that downside part of the equation, the downside part of the wave, which really is what everyone is concerned about. Keep the upside, lose the downside. And I think you can use options to great effect to help you do that. But now it's time to roll on out of our basic training segment and into my personal favorite part of the show, because it's your part of the show. It's time once again for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call segment. Like the man said, this is the portion of the show where you guys get your chance to join us on the program and sound off, make your voices heard, your questions, your comments. A lot of great ways for you guys to do that. Of course, surf on over to theoptionsinsider.com. Leave a comment or question on our show notes. We'll route it to the appropriate program. Shoot us an email, questions@theoptionsinsider.com. Be sure to put in the subject line, question for Dan Passarelli. I'm just joking. Question for Options Bootcamp there in the subject line, so we know which show to route your question to. And of course, find us on social media, twitter.com/options, facebook.com/theoptionsinsider. And last but not least, use that app I just mentioned at the top of the show. Click on the contact suite there in iOS. I think you have to do it in individual episodes in the Android and Kindle Fire versions, but that's going to be changed pretty soon too. So a lot of great ways for you guys to use the app to get in touch with us as well. So no shortage of ways to make your voices heard here on the mail call segment. All right, first up, we have a question from a user goes by the handle TelStorm, and he writes, this question is for Options Bootcamp. Please do discuss when to adjust long protective put with stock. When to sell the put versus just close the position. Do you roll to a lower strike or to a put spread? Thanks. This gets exactly on the heels of what we talked about on our recent episodes about adjustments. We took a lot of that conversation from the long call vertical side, because that seems to be easiest for a lot of people to really wrap their heads around calls and call verticals for whatever reason versus puts. But a lot of that methodology, a lot of those use cases still apply. But we didn't discuss exactly the long put versus stock. I know there are a lot of different reasons and a lot of different levels you may want to adjust on a position like that. So maybe, Dan, we'll start with you. If you have a client coming to you and they have a long put, long stock, what are some of the scenarios you give them to adjust and either, I should say, close out the position?
Well, I mean, I guess one of the things you can do, we talked about legging into the, protective put spread. But I mean, for me, I think the best thing to do is to leg out by divesting of the put. Just get rid of that long put once you don't need it anymore. It's just a time decay suck. And once it's insurance that you don't need it anymore, there's no point in having it. A protective put should be like a hot potato. Like, okay, I need this insurance until I don't need it, and then I'm getting rid of it.
It's a good analogy. I like that. Hot potato, because you're right. That is. It's decaying every day. You're paying for that insurance. The nice thing about options as a form of insurance versus your standard insurance policies elsewhere is that you can cash that in at any time, which is kind of nice. So if you don't need that insurance, A, or B, let's say the underlying drops to a level. Hopefully when you put on that put, you had a level in your head of if the underlying drops to this level, I am going to close out this put and maybe roll it to a lower strike because you've gotten all the benefit you needed out of that protective put. The underlying moved to that level where you wanted to have the protection, so you can roll it out. Then if the underlying retraces it, which you think is going to do, obviously because you're still long the underlying, then you can of course benefit from that, and you've still gotten the bang for your buck out of that put. So remember, it's a hedge. It only really works for you if you actually use it. On the flip side of that, if the underlying keeps dropping, you should also have a scenario in your back pocket for that. I am going to close out this position if the underlying gets to this level, because clearly my viewpoint on the underlying, something fundamentally has changed here, and I need to adapt to that. So when you're putting this on, Mr. TelStorm, I would hope that when you buy that underlying and then you let it rally and you buy that protective put to lock in those gains, you have a limit order maybe already working on that put. Say, hey, if the underlying drops to this level, the put gets to this level, I'm going to sell it out, and then I will re-examine from there. Do I want to leg into yet another put lower down, which is again kind of getting into the legging scenario, sell out the long leg, roll it down to another farther out of the money put, or do you want to readjust and maybe close out the stock position? That's up to you at that point, but you should have these parameters in place when you first put the trade on. And also just a good rule of thumb for puts in general is make sure if there is a retracement, you do want to consider rolling or taking it off, like Dan said, because you don't want to let all of that profit you've accrued in that put to offset the drop in your underlying just kind of waste away to nothing. You want to make sure you get some bang for your buck out of that protection, whether that's rolling down, whether that's rolling to a different month, whatever the case may be. But there's a lot of ways to take that bang for your buck and keep it and also still have the protection for your underlying. John, anything for Mr. TelStorm here before we roll on to our last question?
I think Mark's idea that if you put the protective put on and stock goes down, just roll it down. Keep the protection on, roll it down. I think that's that's wonderful advice.
Well, wonderful. Well, I'll put that feather in my cap, sir. Thank you. All right. Next up, we have a question from Mr. Alexander Samuels. He's writing here. He's a local boy from Chicago. He writes, "You would never know you guys are Chicagoans from the way you complain about the weather." Well, in my defense, I will say it's mostly Dan, who's from Frankfurt, which we all know is not Chicago, and of course John, who's from New York, which is also not Chicago. I am blameless in this, sir. So there you go. I blame all of you guys. But no, seriously, he goes on to write. Actually, he writes, but seriously, can you discuss which options tools you guys prefer for analytics and trading? Do you have a certain products you use every day? Are they in the price range of a basic options trader? I trade maybe 20 times a month, mostly income trade, short puts, wheels, covered calls, etc. What should a guy like me be using? Great question, Mr. Alexander Samuels. We get variations on this a lot on a bunch of shows on the network, including this one. I think we may have touched on it, but it's been a while, so let's revisit this. There are a lot of different tools. I will start off with the conversation. Of course, John can take it a little bit more in depth, but the tools that your average retail broker gives you now are, I would think, sufficient for a lot of the use cases that someone like you, Mr. Samuels, would have. where they give you a lot of, and obviously they give you the options chains, but they give you a lot of that plus now. They'll give you spread tools, they'll give you your Greeks, they'll give you all these different position parameters you can look at and adjust on the fly, volatility skew, what have you. A lot of that stuff was kind of just a pipe dream or only the domain of professionals just a few years ago. So check out your broker first. Hopefully it's Sogo, but it could be any broker you guys like to use. And check out what tools they really have available, because that's going to save you a lot of money. That said, if your broker is lacking in one specific area, there are some tools out there that I like to use that are in addition to your typical brokerage platform. The one I'd say I rely on the most day to day is probably LiveVol. And that is a analytics platform that was designed for kind of professional options traders. I know a lot of market makers still use it alongside their data screens and other feeds from their firm. And it just gives you a lot of up-to-date options analytics and the options chains, a lot of which you already get from your broker. But they also give you kind of updated time and sales. There's some scanners in there you can use to scan for unusual activity and that sort of thing. I believe their retail platform is either $99 or $199 a month, one of those two. So $200 a month, you're talking $2,400 a year. So if you're only trading 20 times a month, it may not be really worthwhile for you to invest that extra money in it. But if you are using it, who knows? If it saves you one trade here or there, then it could pay for itself. So I do like LiveVol. Trade Alert is another one, but that's more in the options flow analytics. And that's really for very professional customers. We use that a lot on our site to analyze unusual activity and that sort of thing. That really isn't the domain of the retail options trader. So for me, I think my pick would be LiveVol Pro, I should say, actually, if you can swing that either $99 or $199 a month, whatever the monthly rate is. Dan, what's your take here for Mr. Samuels?
Yeah, I mean, it's kind of hard to go too terribly wrong. I mean, when me and Mark and John were floor traders, the software that we had access to was nowhere near as good as what you can get for free in almost any option-friendly online broker, and we had to pay a lot of money for it. So, I mean, don't overthink it and sweat it too much. I do agree with Mark that probably some of the best option tools you can get are from LiveVol. I really, really like theirs, but really, I mean, you can get pretty much what a typical trader needs with most option-friendly online brokers.
John, take us home here. Talk about some of the tools you guys offer and what you think a retail customer should be using these days.
Yeah, I'm a big fan, and I'll be the third person to tout LiveVol. The only thing I'll say about LiveVol, I think that that's really for the little more advanced trader. I mean, it's $200, or I think even more a month, and they have great tools, and I use it. But again, for the 98% of the traders out there, retail traders, I'm not sure if that's going to be a cost, very, very savvy on that cost basis. What we do is that if a customer is a big customer and they would like something like that, a lot of times what we'll do is, we'll subsidize it for them. We'll give them a VIP rate or some kind of little kickback, or not kickback, it's a bad word, but a subsidy, so they can go out and get something LiveVol. I mean, we just rolled out our new screener. That's for equities, but that does give you a lot of, historical volatility numbers. We have a new platform coming out that's going to have implied volatility. You can chart the different options and implied volatility. So I think the SIBO has some screeners. I'm not necessarily a huge fan of screeners, because if you go to the average screener and you put in, I want to look at the best put spreads that are available or the best call spreads, what will happen is that they'll find some outlier 1 or 2 cent bid option in some out of the money put somewhere, or out of the money call, and then they'll pair it up with some other call, and they'll say, well, this is a very attractive, trade to put on. So unless you really know what you're doing, I'd just be careful with that. And of course, most of firms, including Sogo Trade, they have all the P&L calculators and all the option calculators and probability calculators. So Dan's right, Mark right. Most of the tools are available to the customer right now.
Yeah, the retail client really is very spoiled right now. The stuff they have access to really would have been voodoo. I remember when I walked on the floor at the handset that actually updated my Greeks and my positions on the fly, people thought it was voodoo. And that wasn't that long ago. So people have access to all this stuff, and yet they're clamoring to pay for more. So c'est la vie. But check out your broker. Go over to SoGoTrade.com, see what they have, of course. Check out your brokerage site. Click the tools, check them out. There's probably some advanced stuff there you don't even know. Maybe some brokers offer some additional stuff you could pay for as well. So check out what your broker has to offer. I'd wager for a lot of you guys, including maybe you, Mr. Samuel, is about 20 trades a month, probably will be sufficient for your needs. But if not, I think LiveVol is the consensus choice if you could swallow that $2,400 a month, $2,400 a year, if that's worth it to you. All right, great questions, everybody, but that is going to do it for this episode of Options Bootcamp. As usual, before we go, let me check in with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods that may interest you, the listener, until the next time we gather together here on the old basic training ground. Starting with you, Mr. Passerley, what's cooking in the land of MTM?
Oh, man, I got to tell you, I am busy as one-armed. What is it? What's that idiom? One-armed.
Busy as a one-armed bandit. Is that what you were about to say? I don't know if that really works.
I don't even know what I'm talking about.
You've been drinking again before noon, sir.
Anyway, I'm pretty busy lately. One of the things that has been on my calendar for about a good week and a half now, but I keep moving it to tomorrow's date because I just don't quite get to it. But on June 6th and 7th, I will be hosting an in-person class right here in Chicago, the Windy City, when the weather should be above freezing by June 6th and 7th, I hope. And I'm really, really excited about that. We've got some great fun stuff planned in addition to, this 2-day class. I think we're going to work in a Cubs game for the students. It's going to be really, really fun. So if people are interested in that and want to get in early, because if I do this Cubs rooftop thing that I'm thinking of, I have to buy a finite number of tickets now. So I really, really do have to cut off the class at a certain number of people, not just the sales technique. So if anybody's interested in that, wants to get in early, send me an email. You know how to find me, dan@markettaker.com.
Sounds good. Check it out at MTM, listeners. And Mr. Critchley, what's cooking over there in the land of SoGoTrade.com?
We're very excited that we have a new mobile app that we're beta testing right now. It's going to be for the iPhone to start. It's an update from our mobile application now, but I'm really excited about that. So that should be coming out, hopefully really soon. And of course, we have our screener just came out and our new Elite platform coming out. So the next few months, we got all kinds of stuff to do. So looking forward to a great year, and see you guys next week or in a few weeks.
All right. Thank you for that, John. And of course, on behalf of John and Dan and myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing, and of course for sending in such great questions. Keep it up. Don't forget to check out the mobile app, and we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by SoGoTrade, an extraordinary value in online trading. Why pay more for the same trade when SoGoTrade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.